Hey there and welcome. We are about to demystify one of the biggest cornerstones of accounting, the golden rules. And I promise by the time we're done here, you're going to see just how simple and logical this all really is. Okay, let's jump right in.
So let's be honest, does the word accounting kind of make you nervous? Yeah, I totally get it. For a lot of people, especially if you didn't study commerce, all the jargon and rules can feel like you're trying to learn a whole new language.
Well, that feeling, it ends today. Seriously, because you're about to get the master key that unlocks the whole thing. So what's this big secret I'm talking about? Well, it all comes down to one simple, fundamental idea. This is the engine that drives all of accounting, and it's all about the perfect balance between debit and credit.
Okay, so think of it this way. Every single transaction, no matter how small, has two sides to it. It's like a seesaw that always has to be perfectly balanced. On one side, you've got the debit. That's the receiver, or what comes in. On the other side, you've got the credit. That's the giver, or what goes out. Get this down, and you've got the foundation for everything else. It's that important. All right, so now that we have this debit and credit thing, how do we actually use it? Well, you just need to know where to put them. It's kind of like sorting mail into different boxes. Every transaction you ever see needs to be sorted into one of just three specific buckets. In accounting, we just call them account types. And here they are, our three magic buckets. Seriously, every transaction, I don't care if it's buying a coffee or buying a skyscraper, it's going to fall into one of these three categories: personal, real, or nominal. So let's break down what each one actually is. Okay, first up is the personal account. And this one is super easy because it's exactly what it sounds like. It has to do with any person, any company, any institution. So if you see a transaction involving a specific name, like Rom, or a business, like your bank, boom, that's a personal account. Next, we've got the real account. The key word here is real, as in stuff you can actually see and touch. This is for all the physical assets a business owns. We're talking about actual cash, the desk and chair in your office, the building itself. If you can kick it, it's probably a real account. And last but not least, the nominal account. This one is all about the flow of money, the day-to-day pulse of the business. It tracks all your income and all your expenses. So think things like paying salaries, collecting rent, making a sale. Basically, if it's about the money coming in or going out from your operations, you're looking at a nominal account. Okay, deep breath. This is where it all clicks into place. We have our debit and credit idea, right? And we have our three types of accounts. Now, it's time to bring out the master key that connects everything. Get ready for the three golden rules of accounting. So let's start with personal accounts. The rule is so simple, it's beautiful. Debit the receiver, credit the giver. That's it. Debit the person who gets something, credit the person who gives something. Let's look at an example to see how easy this is. Okay, check out this example. We paid 1,000 rupees to Ram. Let's apply the rule. Who is receiving the money? Ram is. So, debit the receiver. We debit Ram. What did we give away? We gave cash. So, credit the giver. We credit the cash account. See? Perfect balance. All right, rule number 2. This one's for our real accounts. Remember, the physical stuff. The logic is just as straightforward. Debit what comes in, credit what goes out. Simple as that. Let's try it out. Say we bought some furniture for cash. What physically came into the business? The furniture did, so we debit the furniture. What physically went out of the business? The cash, so we credit the cash. Once again, everything is perfectly balanced. You're starting to see the pattern, right? And here we are, the final golden rule. This one is for nominal accounts, and it's huge for understanding how well a business is actually doing. The rule is debit all your expenses and losses, and credit all your incomes and gains. Let's look at two quick examples that show both sides. When you pay rent, that's an expense, right? Money is going out to cover a cost, so you debit it. But when you receive a commission, that's income. Money is coming in, so you credit it. This rule basically just sorts all your money-making and money-spending activities into two neat piles. And that's it. That's the whole system. You've just learned the core logic that holds up the entire world of accounting. How cool is that? So let's do a super quick recap just to lock it all in your brain. Think of this as your new accounting superpower cheat sheet. Okay, let's nail this down one last time. Personal account, debit the receiver, credit the giver. Real account, debit what comes in, credit what goes out. And nominal account, debit all expenses, credit all income. That's it. That's the logic that keeps the books balanced, always. So now you have the toolkit. You can look at any financial transaction, figure out the account type, apply the right golden rule, and know exactly what gets debited and what gets credited. You've got the power. So my only question for you is, what's the next transaction you're going to analyze?